So let's talk about the stock market. Imagine a giant marketplace, but instead of selling apples or cars, people buy and sell tiny pieces of companies. These little pieces are called stocks. When you buy a stock, you become a part owner of that company. If the company does well and makes a lot of money, the value of your piece, your stock, goes up. You can then sell it for more than you paid for it. This is called investing. People invest their money hoping to grow it over time, maybe for retirement or to buy a house, or just to have more financial security. It's a way to make your money work for you, which sounds pretty awesome, right? The 1920s in America was a time of great excitement and change. They called it the Roaring Twenties for a reason. World War I was over, and new inventions like the radio and the automobile were changing how people live their daily lives. There was this feeling of endless possibility in the air, a sense that things were only going to get better and better. This optimism spilled over into the economy. Factories were producing more goods than ever before, and people felt confident. This confidence led many ordinary Americans to look at the stock market as a golden ticket, a fast track to wealth that had previously seemed out of reach for most people. Before the 1920s, the stock market was mostly a place for the very wealthy and for financial professionals. But during this decade, that all changed. It became a national obsession. You'd hear people talking about stocks everywhere, at the barber shop, at dinner parties, even on the street. Newspapers printed daily stories of regular folks, like secretaries and factory workers, who had become rich overnight by playing the market. It seemed so easy. You just had to pick the right company, buy some stock, and watch your money multiply. This created a powerful sense of FOMO, or fear of missing out, long before we had a term for it. This widespread excitement created what we call a bull market, which is when stock prices just keep going up and up. It felt like a party that would never end. The rising prices seemed to prove that everyone was right. This was the new normal. For a while, it worked. People who invested saw their money grow at an incredible rate. A person could invest $1,000 and see it turn into $2,000, then $4,000. This success created even more excitement, drawing more and more people into the market, each one hoping to get their own piece of the American dream that seemed to be for sale on Wall Street. Now, here's where things get a little shaky. As more people wanted to buy stocks, their prices went up. But soon, the prices weren't connected to the actual value of the companies anymore. People were buying stocks not because they believed in the company's long-term future, but because they believed the price would be higher next week. This is called speculation. It's less like investing and more like gambling. The whole system started to look like a giant bubble, getting bigger and bigger, but the air inside was just hope and excitement, not real, solid value. The foundation of this booming market was becoming dangerously thin. To make matters worse, many people didn't have enough cash to buy all the stocks they wanted, so they started borrowing money to do it. This risky practice is called buying on margin. Here's how it worked. A person could put down just 10% of the stock's price and borrow the other 90% from a stockbroker. For example, you could buy $1,000 worth of stock with only $100 of your own money. This seemed like a brilliant idea as long as prices kept rising. If your stock went up, you could sell it, pay back the loan, and keep a huge profit for yourself. It was like pouring gasoline on a fire. This borrowing created a massive amount of debt in the system. The entire stock market was basically being held up by borrowed money. It was like a giant house of cards. As long as no one bumped the table, everything looked fine. But what would happen if stock prices stopped going up? What if they started to go down? If that happened, the broker who lent you the money would make a margin call, demanding you pay back your loan immediately. If you couldn't, the broker would sell your stocks to get their money back, which would push the stock prices down even further. It was a recipe for disaster waiting to happen. By the summer of 1929, some smart people started to get nervous. They saw that the prices were ridiculously high and couldn't possibly last. Some big investors quietly began to sell their stocks and take their profits. The market started to wobble a bit. Prices would dip, then recover, then dip again. It was like a series of small earthquakes before the big one. But for many people, the party was still going strong. They ignored the warning signs, believing that any downturn was just a temporary blip. They kept borrowing and buying, pushing the bubble to its absolute limit, completely unaware that it was about to pop in the most spectacular way possible. The beginning of the end came came in late October 1929. The panic didn't happen all at once. On Thursday, October 24th, the market took a huge dive, which became known as Black Thursday. Panic started to set in, but then a group of powerful bankers stepped in. They bought huge amounts of stock to try and stop the bleeding and show everyone that things were okay. It seemed to work for a little while. The market stabilized over the weekend. Many people breathed a sigh of relief, hoping the worst was over, but it was just a temporary pause, a calm before the storm that was about to hit with full force. That storm arrived on Tuesday, October 29, 1929. This day is now infamous as Black Tuesday. When the market opened, it was pure chaos. Everyone was trying to sell at the same time and nobody was buying. The ticker tapes that printed stock prices fell so far behind they were practically useless. By the time a price was printed, the stock was worth even less. The margin calls that people had feared were now happening all at once. Brokers were demanding their money back, and when people couldn't pay, their stocks were sold for whatever they could get, pushing prices down a terrifying spiral. It was a complete and total meltdown. The human cost was immediate and devastating. Stories from that day are heartbreaking. People who had been millionaires in the morning were broke by the afternoon. They had lost everything: their life savings, their retirement funds, the money they had borrowed. The dream of easy wealth vanished in a few short hours, replaced by a nightmare of debt and despair. Crowds gathered outside the stock exchange and brokers' offices, their faces filled with shock and disbelief. The optimism that had defined the Roaring Twenties was shattered. The party was officially over, and the cleanup was going to be brutal. In a single day, billions of dollars of wealth simply disappeared into thin air. The crash didn't just affect the rich investors. It hit everyone who had put their faith and their savings into the market. It wiped out the savings of ordinary families who had been convinced that stocks were a sure thing. The psychological shock was immense. The belief that America was on a path of permanent prosperity was destroyed. People's trust in banks, in the stock market, and in the entire economic system was broken, and this collapse of confidence would have consequences far beyond Wall Street. The 1929 crash was more than just a bad day for investors. It was the trigger for the darkest economic period in American history, the Great Depression. Here's how it connected. When the market crashed, it created a ripple effect. People lost their savings, so they stopped buying things. When people stopped buying things, factories had to slow down production and fire their workers. When workers lost their jobs, they had even less money to spend, which made businesses fail. It was a vicious cycle that dragged the entire economy down. The crash popped the bubble of confidence that had been holding everything up. As businesses closed, unemployment skyrocketed. By 1933, about 1 in every 4 Americans who wanted a job could not find one. This led to widespread poverty and hardship. Families lost their homes and farms because they couldn't pay their loans. People stood in long lines for bread and soup just to get a meal. The optimism of the 1920s was replaced by the desperation of the 1930s. The crash didn't cause the Great Depression all by itself. There were other problems like trouble in the banking system and farming, but it was the dramatic event that kicked it all off and made everything so much worse, so much faster. So why is it so important to learn about this? Well, the crash and the Great Depression taught us some very hard lessons. They showed the dangers of too much borrowing and wild speculation. They taught us that a stock market that is disconnected from the real value of companies is unstable and bound to collapse. In response to this disaster, the United States government created new rules to protect people and make the financial system safer. They created organizations like the Securities and Exchange Commission to oversee the stock market and prevent the kind of fraud and abuse that was common in the 1920s. Ultimately, studying the 1929 crash is a reminder that history matters. It shows us how quickly things can change and how important it is to have a stable and fair economy. The story of the crash is a cautionary tale about the dangers of greed and getting carried away by excitement. It reminds us that while investing can be a good way to build wealth, it also comes with risks. Understanding what went wrong in the past is one of the best tools we have to try and build a better, more secure future for everyone. And that, as we say in the biz, is the bottom line.